With so many markets and instruments to trade, it can be difficult for a new trader to settle on what markets to trade. As a new trader, you want to trade in those markets that offer the fewest barriers to entry, that have the greatest amount of trading flexibility, and can grow with you as your skill level and experience grow. Futures are a multifaceted trading product that allows traders to speculate in the price of many different financial instruments and commodities. Trading futures is like trading stocks, except that futures contracts expire on a certain day. Futures do not have restrictive day trading rules, and you can easily trade long and short. There are several other key benefits to trading futures over other trading instruments that we will discuss here in this video. The 5 main benefits of trading futures includes 1. Contract sizing to fit almost any account size. With some futures having initial trading margins under $150 to place an initial trade, even the smallest account size can start trading with futures. 2. Increased leverage, which provides a trader with the ability to control larger positions with fewer dollars. 3. Virtually 24-hour trading that allows traders the flexibility to trade on their schedule. 4. Trade many diverse markets that span the full human experience: food, energy, interest rates, and others. And 5. Futures have tax advantages over stocks. One of the greatest advantages for new traders is the wide assortment of futures markets that can be traded and the wide variety of contract sizes. Many futures instruments have micro-contract sizing, allowing new traders to place trades with just a few $100s of initial capital called margin. A simple definition of futures margin is the minimum amount of money you need in your trading account to place an initial buy or sell futures position. This creates leverage, a key benefit to futures trading. For example, one of the most widely traded futures is the E-mini S&P 500 index. Every time the price moves 1 point up or down, the value of an E-mini S&P futures contract goes up or down $50. The margin to put on that trade is around $1,500, but can be less for day traders who close positions before the end of the day. There's also a micro version of the E-mini S&P 500, which is 1/10 the size, offering initial margins of around $150 or less to place a trade. These types of micro contracts allow traders to gain valuable experience with real dollar trading with smaller accounts and lower risks. Keep in mind that margin rates are subject to change over time based on market risk and exchange guidelines. Leverage creates increased opportunity along with increased risk. Placing a futures trade on margin creates leverage. This initial margin is usually only a fraction of the futures contract's total value, allowing you to control a larger position with fewer dollars. Think of margin leverage as your good faith guarantee to cover any trading losses you may incur. And there's no cost incurred by your brokerage for this margin. Always remember that leverage is a double-edged sword. Sure, small price changes in the futures price can generate good gains. They can also result in significant losses. And losses could be higher than your original margin amount, or even more than the capital in your account. Always have the appropriate risk management stop-loss orders in place. Virtual 24-hour trading. Many of the actively traded futures trade 24 hours a day, 6 days a week, starting on Sunday night and going through Friday's close. Many of these overnight markets are traded on the CME GlobeX system. Generally, futures are most active during the regular U.S. market hours, but many futures have good trading volume as overnight trading cycles through the international markets, beginning in Europe, then Asia. 24-hour trading allows you to trade on your schedule when it's convenient. If something critical happens in the news at night outside normal stock market hours, futures trading gives you an opportunity to trade that news before the stock market opens the next trading day. Trading diverse markets. Trading futures allows you to trade the many diverse markets that drive the economy of our everyday lives. Most of the available futures to trade can be organized into these 6 key groups. The main futures groupings are 1. Major market indexes. 2. Interest rates. 3. International currencies. 4. Precious and industrial metals. 5. Energy. And 6. Agriculture. For example, the energy group is comprised primarily of crude oil, heating oil, natural gas, and gasoline contracts. In recent years, futures have been added that allow you to trade cryptocurrencies. Tax advantages. Finally, under IRS Rule Section 1256, futures have tax advantages over stocks related to capital gains on futures trading. The way it works is that 60% of futures trading gains are taxed as long-term gains, regardless of the holding period, and the rest, 40%, is taxed as short-term gains. Tax laws and capital gain tax rates are subject to change. Always check with a tax advisor regarding your situation. Every futures trader has their own unique reasons for trading futures. It could be leverage, the diversity of markets, or any of a number of others. Whatever your reason, futures offer the widest range of opportunities for traders of all skill levels and account sizes. Which brings us to our next video and topic: futures trading nuts and bolts, the mechanics of futures trading.